Good afternoon.
Good afternoon.
So in the morning we were discussing on financing through the bond, as well as we went a step further and discussed on how we get the valuation, how we value bonds. Okay, be they be redeemable, irredeemable, or be they be convertible. Okay. Now I want us to know we discuss on equity. Okay. So on equity financing, as we had mentioned on that mind map, which we had drawn together, we did say that when it comes to equity financing, we can issue or we can obtain equity financing mostly from two main sources, either from the issue of new shares or from the use of the company retained earnings. Okay, so issue of shares for the company use of retained earnings. And you see that the key distinction, okay, is that the use of company retained earnings means you're going to be using the company previous year's earnings, okay, a previous year profit in quote, okay, to finance the company current need, okay. So, or even a case of efficient working capital management, okay, in itself can also be considered a sort of company efficient use of the company funds, okay, can also be used as a capital source, okay, working capital, okay. So then you can also have the use of obtaining equity finance through the issue of shares, okay, and you mentioned a number of ways that the company can be able to obtain equity finance through the issue of shares, okay. We have the case of raising of shares, okay, IPO, we call it initial public offering. You can have secondary issues of the company shares, okay. We can have introduction, we can have placement. So there's so many ways you can be able to obtain or to obtain capital through the issue of shares. So you may want to consider what is our position, okay, as a company. What are the pros and cons of each of the different way of financing ourselves, okay. So you mentioned that one of the ways they can be able to obtain finance is through the issue of shares. So what to be, and you do so for you to issue shares, then you must, for example, definitely obtain what we call the stock market listing. You must obtain what we call the stock market listing. What are the advantages therefore of listing? Okay, for example, they can what we call a wide access of pool of finance. Okay, because in case you are going, if you're a public listed company, then that will mean therefore you can be able to issue bonds. Don't forget, in case you are a private company, you can't issue bonds. Therefore, that means in case you have done listing, that means you have more access. Therefore, there is more pool of finance that is available to you. Okay, you can go to issue commercial papers, you can issue bonds in the market. Okay, you can do a right your shares. So you have a diverse array of capital sources which is unavailable in case you're a private company. Okay, then of course it's more improved marketability of shares of the company. Okay, that means therefore it is possible, okay, for you as maybe the original owners of the business company to be able to sell off the markets, the shares to the market. Okay, it's much more easier, okay, as opposed to a case where the shares are privately held, okay, because in case they're privately held, that means therefore to do an exit, then you may have to the one to sort out for the buyer of your shares. In the case of a PLC, an IPO, you don't do that. Just simply make an announcement to the public, hey, I want to sell off my shares. We want to sell off, we want to sell you our shares to the company, and you become therefore a member of the company. So since now the people, okay, are a bit the market is a bit wider, okay, you have more market participants. That implies therefore the share become more liquid, they become more marketable. Of course, it could be enhanced public image. Okay, original owners can sell off their holdings. I think you mentioned that, and also it is possible for us to be able to seek growth through acquisition. Okay, by the method that the capital becomes more available. Okay, then it becomes easy for you to be able to grow as a company. Okay, through acquisition of other companies. Okay, you as equity bank, you can now be able to go to maybe the international market. You go to Congo, okay, and you buy off some other bank. Okay, I think that's what they've done maybe the last 2 weeks or so. That's possible. Okay, definitely. In case therefore you are a public listed company, and therefore it is possible for you to access finance in a much wider way compared in case you have to continue trading as a private enterprise. Of course, the disadvantages, more scrutiny, because now you are a public company. There's more scrutiny. There's going to be more checking of what you're doing in quotes, okay, as a company. Okay, there's more. You're more accountable to a wide array of people, not just the public, not just the investors, even to the public, okay, to the government, okay. So the more people means more pressure. That's one for sure. Okay. Then definitely, okay, the disadvantage is called the cost of rotation. Okay. This is the cost you do incur as you issue shares. Okay. You need to have brokers who assist you with the issue of shares. The writers, okay, pay for the auditors, pay the lawyers to prepare the prospectus for you. Okay. You need to have the accounts audited for the last 5 years. So there are so many costs being carried along the way. By the time you get issue shares, okay, that you may have to consider whether it is worthwhile to actually do an IPO, okay, in terms of cost analysis, okay. In a way, it's a good way of financing yourself. And the way you can obtain listing, okay, or organize your shares, one of them, for example, is the IPO, okay. Now, in the IPO, this is where the company is issuing the shares for the first time ever. Okay? The company is issuing the shares for the first time ever to the members of the public. Initial public offering. Okay. Then you have placing. What is placing? Simply in placing, this way you may not want to invite the entire members of the public to come and subscribe your shares. You can do so through the private placement. Okay. Instead of in public members, you can do so through a private forum. If, for example, it is possible to have 100 investors, okay, who can be able to come and buy the company's shares, okay, you can do so. Why do you need to invite the public members? Okay, you may want to avoid the chaos that comes with an IPO. Okay, so that by doing a private placement, okay, call the members of the company, the members of the one you want to invest in your company, okay, to an IPO or to not an IPO, to a forum, and tell your idea to them that hey, we as ABC company, we would want to sell to you our shares in our company. Okay, we are going to sell one share for this much. Okay, to you. Okay, so you don't go through a public forum. Okay, you'll be, for example, be inviting them through a private forum. Okay, inviting those key investors in the market. Okay, we call the use of placing or simply private placement. And of course, you call the introduction. You have called introduction. An introduction. Now, what happens as a company? If your shares are currently widely held by investors, but you're still a private company, then you can apply for, in quote, like sort of exemption, okay, from going through all the necessary steps, okay. Don't forget, in the case you want to do listing, there's some steps you need to do, okay. One, you need to, for example, in Kenya, go to CMA, you go to NSC. There's a number of steps that you need to go through, which you may want to avoid altogether. So in case, for example, your shares are currently widely held, okay, in the case of UK law, okay, if at least 25% of the shares are widely held by in quote, other people, not just you as the owner of the business, then you can apply for exemption. You simply apply to the regulators, okay, asking you to be converted from being a private company to a public listed company, simply by the fact that your share are currently widely held by the members, okay, not the public, but at least they're widely held by other people other than the founders, in quote, okay. So those are the ways you can do the listing, okay, IPO, private placement, and introduction. Clear? And I mentioned, don't forget, if you're going to issue shares in the market, then of course there'll be cost of flotation, okay, we'll call the flotation cost, okay, and these include a lighting cost. Don't forget, you need to hire a writer, the company that will be assisting you to do the issue, okay. You are a Safaricom, okay, you don't want to do the issue yourself, so what do? You invite CBA, okay, no, not CBA, it's called, you invite Citibank, okay, okay, to help you in issue your shares, okay, you as maybe Safaricom, for example, okay. So if you do so, okay, you'll be inviting that party to come and help you out in the issue. You pay them definitely, okay. And for 45+, the underwriting cost. When you call the stock market listing, you have to pay the CMA definitely. Okay, you have to pay the NSC. You're not going to list for free. Okay, you have to pay. Okay, then you have fee for issuing houses. Okay, auditors, as I mentioned. Okay, charges for printing. You have to prepare the prospectus. Okay, you have to give these prospectus to different members of the public. Okay. Cost for advertisement, you need to, for example, hire advertising agency to help you out in branding, in mass communication, okay, the mass media, in short, okay. So the all costs will be carried along the way, okay. So as I had mentioned, the cost is be quite high, okay, in terms of share flotation, okay. So you may have to, in quote, sit down and try to get to know, is it worthwhile, okay, for us to issue these shares, okay, because the cost is quite high. The cost of floating these shares. Now, one other way you can be able to obtain the finance is through what called the right issue of shares. Okay. Now, in the right issue of shares, okay, this is where, as a company, you're going to be issuing your shares, okay, not to new members of the company, not to the public as per se. You're going to be issuing these shares to the existing members of the company. Okay. So you call upon the current member of the company, hey, we as ABC, okay, let's include ABC company, okay, the board of directors would want to offer you as a current shareholder an option of buying the company extra shares at this particular price, okay. So include there'll be sort of a prospectus the company prepares addressed to the current shareholders of the company, okay. However, don't forget, for the company to do a right issue share, that means they've already done an IPO, okay. They are already a public listed company, okay. So you're only calling upon the current shareholder to come and subscribe to the company's shares. Okay. Conventionally, the issue price, okay, is given at a discount to the current market price. Okay. If currently the share price of the company is 10, then the new share the company is offering to the shareholder will not be at 10. It will be, for example, at 9.5 or even at 9 or even at 8. Okay. So conventionally, the issue price is a discount to the current market price per share. Okay. And the shares that will be offered, okay, are on what we call pro rata basis. They are on pro rata basis. Now, what that means is that the new shares that will be offered by the company to the members of the company, to the members of the company, the share of the company, they're going to be based on what you own. In case currently you own 10% of the shares of the company, okay, if you own 10% of the share of the company, then the new share will be offered to you will be 10% of those new shares. Okay. If you own 30% of the company of the current company shares, then the new shares will be offered to you 3%. Okay. So in case you own 30%, you'll be receiving 30% of the company new shares. Okay. And because there is of right issue share, the right issue shares through the pro rata. But definitely as a company, you have to have being in a meeting. Okay, you don't just wake up one day and decide you're going to do right issue shares. You call upon the key shareholder, ask them that, hey, we would want you, okay, you as our key shareholder, this is our proposal, okay, we want to get 10 billion to invest in this particular project, okay, this is the cost we've been carrying. Now we want to offer you a right of shares, okay, a right of shares, okay. Now, if those major shareholder agree to it, then of course now we can go ahead as a board and make the announcement to the rest of the public members, to the rest of the shareholders of the company. But of course, you must be in the current shareholders of the company must be the current major shareholder of the company must be in support of this particular motion. The share price that I mentioned is going to be at a discount to the current market price. Okay, the price you'll be buying one new share is referred to us as the offer price. Okay, this will refer to as the offer price. Okay, this will refer to as the offer price. Okay, which will be the share price, the new share, the price at which the new shares being offered will be trading at, will be the company is asking for. Okay, we are going to give this one new share, but at what price? The offer price. Clear? Generally knows that upon the announcement of the right issue share, okay, there might be what we call a drop in the share price. Okay, don't forget this is just an announcement that hey, we as ABC company in the next year, in the month of March, we are going to be we shall issue a right. We are going to do a right issue. Okay, so today, okay, once the news hit the market, there might be a drop in the share price. Okay, why? As the market try to synthesize the information, try to know to understand where are you going to be putting this money into, what's the value addition, okay, we're getting as a company in case you go ahead and invest your money in this project. Okay, so the market is going to be so that a bit of some few minutes, okay, or even maybe in case the market is not very deep or very is not really quite deep, of course it may take even days. Okay, but generally for most markets, those that are markets that are a bit more advanced, it will take simply some few hours. Okay, as the market try to understand, synthesize the new information. Okay, so therefore there might be a drop in share price, which after that, which therefore will go back mostly to its normal trade price once the markets have a good understanding of whatever is the company investment they want to take with the funds they want to raise through the shares. Okay, now once the offer becomes open, okay, or rather the share upon that announcement that has been made, they will say the share may trade or call come right. Okay, or call the come right. Come right means therefore that in case you buy the shares, then you have the right to even get the new shares that will come with those rights. Okay, that will come with those new shares. Okay, that means therefore as a if you're going to buy the shares of this company, okay, let's say in the month of December, okay, the offer is or will be made in the month of April or February. That means therefore that you buy the share plus the rights which will be taken up in the month of February. So it is with the rights, okay, come right with the rights, okay. Now, if, for example, you buy the shares after, okay, the book, most time the company making what we refer to as the book date, okay. Let me just draw a chronology of the events, okay. Okay, so most of the time, okay, let's use that example of giving. So now we're in the month of November. So in the month of November, so today is 17th, okay, they can't make an announcement. So refer that as the announcement date. So announcement date. That in the month of February, you get over new shares. So assume 1st of February, okay, 2020, this 2021, okay, this is again be the excite date, and this is again be the what did they call it? Not excite, the exercise date. This is called the exercise date. The exercise date, okay. That means therefore, you can buy the shares of this guy. That's the share because the right to buy the new share becomes open, okay, to the shareholder of the company on the first of April. So you as shareholder, you can buy the rights being offered to you, okay, from the 1st of February. I see that remain open for the time month, okay, all the until the 28th, okay, 28th of February, okay, it closes. This called therefore the X right date. Okay, the exit date. Okay, but I mean, therefore, in case you buy the shares, let's say on the 1st of March, then you don't get the rights. Okay, not get the rights. Okay, the rights have even expired. Okay, we call this the rights have expired. We call the X right date. Okay. Now, most of the company will be closing the book. They say that we as a company, we can't leave the book open forever. Okay, you're going to close the book, let's say on 29th of January. Okay, we call the book date. Okay, this is called the book date. Now what that means therefore is that in case you buy the shares on the 29th of January, then if you buy the after 29th of January, as soon as you buy on 30th of January, then you don't buy the rights. You don't the share that comes with no rights. Because whoever is going to be the books of the company on 29th is one who will be receiving those extra rights. Okay. So therefore the share price that trade before the book closes is what we call the come rights. This is the come right, okay. After the expiry, this is referred to as the exit, the exit price, the exit price, okay. What was the exit price and the come right price, okay. That's a key difference between the share price, the exit, and the come right share price, okay. Now you may want to make a decision,
So,
okay. Yes.
so can we also say that for come rights, you are expected to receive dividends in the next whenever they pay the dividends next, you receive it then?
That's called it's called come dividend, okay. It's simple, but it's called what called come dividend. Come dividend.
They're both different, right?
Yeah, they're very different. They're both different. Okay. Now, come dividend means for that you are anticipating
Okay.
to get the dividend. Come right means you're anticipating to get the right issues shares. Okay.
So what do you mean right issues of shares?
Sorry, what do you?
When you say rights, what do you mean? Like what rights issue?
And it means you as current
Rights
shareholder,
for the shares.
you have the right to buy new shares that are being offered to you. That of course simply refers as right issue. Yes.
Okay. So come right means?
Come right means that in case you buy the share, at that point in time, then it means you have the right to buy the new share. The one you just to buy the share plus the right to buy the new share has been offered to you. Do you get it?
Oh, okay. And what about X, right?
X right means that you buy the share, but it has no right as per se. You only buy the share, is it? There's
Okay,
no
so
extra share you'll be getting.
oh,
Yes, it's without the
okay,
right.
okay, fine, I
Right,
understood.
without the rights.
Okay,
It's
okay,
clear.
thank you. Yeah.
Okay, great. So that's on the come right and the X right.
Sir?
So we want to ask, what is the you want to make a decision as shareholder, okay? This offer the share. Don't forget, this is a right to you, by the way, not an obligation. This is a right to you, but not an obligation. So you want to make a decision. Should I buy this new share that are being offered to you? You're being given an option of buying, but not an obligation. It's not a must you buy them. Okay. You may want to buy in case you feel maybe if they are going to be value adding, okay, or not. So you make your own evaluation. Okay. Is there any value to be added to my wealth as shareholder if I decide to buy or not to buy the shares of this company? So the option you have, so yeah, the option that you have as a shareholder, there are three options. You can either exercise the right, you can decide to that means if you buy the new share being offered to you, okay, this is therefore you buy the new share being offered to you, okay, you can decide to sell the right. Now what does that mean? Don't forget these rights are only available to you as a current shareholder of the company. In case you ignore, it means you are passing on that right to the company. I mean, now the company can decide to sell their rights to someone else. If you remember what we were saying about the pro rata, okay? The pro rata means therefore that you as a current shareholder are the only person who has the right to buy the new share being offered to you. If you own 10%, the company will be availing to you 10% of the new shares that they want to issue, okay? If you don't pick them up, then the company has the right to sell them to any other party they deem fit, okay? So you as therefore as the current shareholder, you can decide I'm not going to give the company the right to sell off my rights. So I will sell them myself. You can do so. So it is possible to sell the right to the purchase of the new share. Or you can say to ignore. Ignore the right. Okay, those are therefore the three alternatives available to you as a company as a shareholder. You exercise the rights, you buy the new share being offered to you, sell the rights, therefore you dispose them off to someone else who is willing to buy them, okay, or you can ignore the rights.
Sir?
Yes.
So if you sell the rights, first you have to buy them in order to sell them, yeah?
Not as per se. It's like the company brings you, like let's say it's like a contract, okay, that I am the seller, okay, I'm telling you that I'm going to sell to you this vehicle, okay, worth 10 million, okay. So you are as the person who have the right to buy it at 10 million. If you know there's someone else going to will to buy it at 11 million, you can decide, hey, give me that particular, this is my option, okay? This is my right to have as a current shareholder to buy this motor vehicle at this particular price, okay? So you can decide, why don't I just look for someone else who's going to buy these rights, okay? And if possible, if they're going to buy them at higher price, they're better off for me. You don't actually need to buy them as per se, okay? So you need to show the intention that I'm going to buy them off. I want to buy them off. This right offer to me.
Okay.
But in case, as I mentioned, don't forget there'll be a time limit that you can only do so between 1st of February or the 28th of February. So in case you don't buy in between, then media for the company, we assume you don't want them. Therefore, now the company can sell them off to someone else. Clear?
So here you pretend to buy, but you're selling it.
It's not you pretend to buy it, but the company is like going to avail to you. The company is telling that this is a motor vehicle. You have the option. You can buy it between now and all the way to the end of February. Okay, this is have it. Okay, if by the end of 28th of February we are not going to have received an offer from you, we assume you don't buy it, isn't it? Do you understand?
Yeah.
So yes. Between the 1st and 28th of February, you have not bought it. In case between now 1st and 28th of February, okay, you can decide, I'm going to sell this motor vehicle to someone else. Then you just pay the company. Then, for example, in case you get someone else to buy the motor vehicle at, let's say, 11 million, you ask them, give me the 11 million. Then to go to the company, give the company the 10 million. You remain in course like a profit in that context of 1 million. Do you get it?
Yes.
Yeah, so the company is going to deliver to you. These are the shares. Have these shares, okay? If they are yours until 28th of February. In case you don't take them up, okay, we are going to assume you don't want them. Then we can decide to sell to someone else.
Okay.
It's clear?
Yes.
Okay. Now the next question we want to answer is, therefore, how, therefore, or rather, what is a right? Okay, a right is, I'll use the same term, a right is a right to buy the new share being offered to you. A right is the option of buying the new share being offered to you. Okay, if you have, if there's you're not given, if you don't have this option, then you have no right. Okay, as per se. Okay, so the option that is being availed to you as a shareholder by the company. Okay, where you can be able to purchase the shares of the company. The next question, therefore, how many rights do you have as a shareholder? Okay, how many rights do you have? Now we define the number of rights in two ways. Okay, the number of rights we define them in two ways. First, it can be equal to the new share you'll be getting, the new number of shares, the new number of shares, or the existing number of shares you have, existing number of shares. So can use the number of rights equal that way. Okay, either if currently I have let's say 200 shares in the company, then I can define my rights to be equal to the 200 shares. If the company is telling that I'm going to give you 2 new shares for every 1 share you have, 2 for 1. 2 for 1. I'm going to give you 2 new shares for every 1 share you currently have. Then the company is offering you an extra 400 shares. Okay, that means therefore the number of rights is equal to the number of new shares you have. In this case, in that context, the number of rights will be equal to 400 rights. Okay, so it depends on how do you define your rights to be equal to, the number of rights to be equal to. Okay, there are 2 ways you can define the number of rights to be equal to. Okay, either the current share you have or the new share you'll be receiving, the company is offering to you. Now, depending on how you define the number of rights, now the value of a right is different. Okay, depending on how do you define the number of rights to be equal to. Okay, if we define the number of rights, okay, to be equal to the number of new shares you'll be getting, okay, then we find to it as, okay, that at what price do I pay this new share? How much do I pay for it? I paid, let's for example, I paid $9. Okay, but what the value of the share after all this is done, okay, after everything is done, okay, and the dust have settled, what would be the value per 1 share? For example, equal to 9.5. That means therefore, the share I bought here, this 40 share, the share I bought at this point in time, its value has increased from 9 in quotes all the way to 9.5. Therefore, its value is equal to 0.5. That's the value of the right I bought. Is that clear?
Sir,
Yes.
can we say the 0.5 is the premium?
The premium, it's not a premium as per se, because you paid $9, but the true value in quote is 9.5 of that share. Therefore, is the value of the right is equal to 0.5. The option given to you was 0.5. It's not. You can look at premium, but not a premium as per se. It's simply maybe they increase the value of that share from 9 to 9.5.
So you got the offer price was less than the original value.
Not original value as per se. We refer to that as the X right price. The X right price. That is once
the price the rights price have expired. Okay.
Yes, the equivalent of the X right price. Okay. Now that's how you define therefore the number of rights to be equal to. Okay, equal to the X right price minus the offer price. Okay. The other way, in case you define the number of rights to be equal to is equal to the current share you have, we determine currently what's the value of the per share. The value per share currently, assuming it's 10. Before all this was done, the share were going for 9, were going for 10. Then after the company is offering this right issue, the price will have to drop. Okay. Why? Because the company is introducing new share to the market at a price at the price of $9. It's like you're diluting in quote, okay? Because the current price is 10. However, you're trying to introduce more new share at a price lower than 10. It means because of dilution. Therefore, the decrease in the price of the decrease in the price is from 10 to 9.5, which is equal to, for example, in this case, 0.5. Therefore, the price of this share dropped from 10 to 9.5, the one you have here. Therefore, they drop with the price 0.5. Why do they drop? Because this share were being offered through a ratio share. Therefore, they are dropping because of the new share that were being introduced. What's the drop? 0.5. Clear?
So could you please explain the 9.5 and 9?
Okay, let me just give an example so that makes sense. Assume the company want to offer the current share price, the current market price per share, assume it's current to 10. Okay, the company want to offer new shares at, let's say, $9. Okay, so the new share will be sold at $9, and they're being offered. Okay, the offer is 1 for 2. You're going to get one new share for every 2 shares you currently have in the company. You're going to get one new share for every 2 shares you have in the company. So if currently this investor, let me call it Mr. ABC, has, let's say, 10 share in the company, 10 current share, we can say that the current value of this share, the share of this company, of the wealth of this ABC currently, current wealth will be equal to current wealth is 10 shares, then the current price, which is 10, together for 100. Okay. The new share, assume that the offer this ABC takes up the offer 1 for 2. Therefore, a new share will be half of 10. They're going to get 5 new shares. Okay, their value is equal to 5 share. How much do you pay? You paid 9. Because this is a new share. You paid 9 to get them times 9. Therefore, their value is therefore equal to 45. Equal to $45. Therefore, the total wealth of this investor, therefore, is equal to how much? 100, which was the beginning wealth, plus a new share this person has bought, which is 45. You therefore 145. Okay. The next question, therefore, is you want to ask yourself, what's the value per share? The value, once all this is done, okay, the value per share, which is first actually referred to as the value per share. Let me just clarify it. The value per share referred to as theoretical X, right, price is equal to total value is 145. How many share do you have? We have 10 share, old share, plus the 5 new share. We divide by 15. You get how much? 9 point something? I don't know. What do you get?
9.67.
9.67. Okay. Therefore, the value per share has dropped to 9.67. Okay. Don't forget, this is simply a weighted average value. Okay. Therefore, this is called 9.67. But what was the price? It was 10. The price before was 10. Therefore, the value per share, if we define it as per the current share, this current share of this investor, they are 10. Okay, let me just put a different ink here. They were 10. Okay. Therefore, the value per share, the value per rights is equal to 10 minus 9.67, 0.33. Okay. If we define the number of rights to be equal to the new share, therefore, what's the increase in price? The price increased. Okay. For this share, the share you bought, the new share, you bought them at 9. But what is their current value today? 9.67. What's their value? What's the value? What's the increase in value? 0.67. Clear?
Sir?
So the,
Sorry. Yeah, Nafisa was saying something.
okay. So I just want to add. So the 9.67 is for the every share you have plus
Yeah.
the old one plus the new shares.
Yes, after all is done, after you get to know it, what's in theory, what would be the value per share? It's 9.67.
Okay.
Sakina?
Yes, it's 0.6.
Sorry?
So the
Nazika?
the extra we're getting, the 0.67, it's just like the extra they're earning.
Yes, they increase the price of the new share. You bought them at 9, but now their price has increased to 9.67. So this is the value per right. If you have to define them as the right to be equal to the new shares.
Okay.
Okay. Sakina?
Thank you.
Okay.
Yeah, so as you said, 0.67 is the extra you earn, right?
Mm-hmm.
So and then 0.33 is the loss, maybe we can
Okay,
say.
loss in quote, yes, loss in quote for the old shares, but still they are decreasing because the share were offered. So they're decreasing. So they decrease by the value of the rights they have been offered. They were offering to the market.
So this is a dilution you're
Is it?
saying. Dilution.
Okay,
It's
so
diluting. Yeah.
if you want to create dilution, that's not term we use, okay, as per se, but it's like the company did offer new shares to the market at a reduced price. Therefore, since they offer them at a reduced price, the share have decreased from 10 to 9.7. Then why have they decreased? Because they offered them the new share at a discount. Do you understand?
Yeah.
Yeah, therefore the 0.33, therefore, is like what the company was offering to the current shareholders. Not a dilution as per se. It's not a dilution as per se. It's like,
Okay.
what character? It's like, try to give an
But
example.
0.33 discount.
Sorry?
Discount of 0.33 per share.
Yeah, per share, per new share, defining the rights to be equal to the current number of shares of the company.
Yeah, I get it. Thank you.
Okay, great. So you have to be careful, okay, because sometimes the examiner is very explicit. You get the value per right based on if you are to define the number of rights equal to the new share, the number of rights equal to the current or the existing number of shares. Because as you say, the value is quite different depending on how you define the number of rights to be equal to. Clear? Daisy?
Excuse.
Yes, Brian.
Could you just go through the 0.67 part again?
How you got it?
Yeah.
Okay. So here, currently, the number of shares how many shares do you have? You have 10 shares. Okay. So you have 10 shares. What the value per share is 10. Therefore, what's the total value? Is 10 times 10 to give us 100. The company offers you're going to be giving you one new share for every two. Then how many shares do you get? You'll be getting 5 new shares. Clear so far?
Yes.
But you need to pay them. You're not going to give for free. Okay, you're going to give you a discount, but not for free. Therefore, how much do you pay? You'll be paying 5 share, and per share you give us 9. Therefore, what the total amount you'll be paying us, or what the total value of the share you'll be getting? You'll be getting share worth 145. Therefore, what's your total worth? 100, what you had before, plus a new share, 145. Clear?
Yes.
Therefore, how many shares will be having after? The 10 old share plus the 5 new share, together, therefore, 15 new share. What's the total wealth you have? 145. There was a value per share, 9.67.
Okay. Thank you.
Clear, Brian?
Thanks. Yes. Thank you.
It's clear?
Yeah.
Okay, great. Thank you. Now let's do a question. We apply that concept. We enter one question, yeah? Okay, go through this.
Sir,
Yes.
I have a question. Why, when they are trying to offer the rights issue, why do the market price increase?
Increase.
Yeah.
It decreases, not increase.
Why would it decrease?
Because of that, it's simply because of market is not so sure, okay, of where you want to invest your money in. The market not understand, okay. You want money to where to invest somewhere because you don't just want money. You want to invest that money in a project. So, what is the value of the project you be investing your money in? So, as the market try to understand, it drops because of all the market, because of uncertainty regarding maybe the future of the company, the future of this investment. That's why it normally drops for a short while.
Thank you.
Yeah, and as I mentioned, don't forget, the drop is simply for a very short while. Okay, if the market is quite deep. Okay, the market is good, is advanced in quote. Okay, then the share price drop is only for some few minutes or even some few hours. Okay, it can't go more than days. Okay, but in case the market is not that well developed in terms of understanding the concepts, understanding in terms of participant, for example, then of course it can take some. It can take days and weeks, and the market try to synthesize the new information.
Thank you.
Okay, let's discuss together. In this question, we've been asked to get how many rights are required to buy the new shares. Okay, it's a bit vague because as we have just seen, okay, when it comes to the rights, okay, we may want to determine first is how to define the number of rights. Is it equal to the new share or the old share? Either way, let's do for both methods. Okay, so first, the company market cap, that is simply the total market value of the company share. Okay, market cap is equal to 192 million, giving us the number of shares of the company, number of shares times the market price per share. Therefore, the number of shares will be equal to 192 divided by the current market price. And the current market price will be told is equal to, how much is it?
9.6.
9.6. Yes, 9.6. Therefore, how many shares of the company are currently issued?
20 million.
20 million. Therefore, currently the company has 20 million shares. Then, therefore, in case you want to get the total rights of the company, and if you define the number of rights equal to the current share, then they have 20 million rights. Don't forget the rights can be equal to the current shares or the new shares. So in case you define the number of rights equal to the current share, the existing number of shares, then you have 20 million number of rights. Or in case you want to look at the other side, the number of rights equal to the new shares, the company want a capital, okay, equal to 45 million. And this give me this through the ratio share. Therefore, the number of shares to be issued, okay, times the issue price. Therefore, the new number of shares that need to be issued, is equal to 45 million times we divide by issue price, which is 9. Therefore, 5 million new shares need to be issued. Therefore, if you define the number of rights equal to the new share, then you have 5 million rights. Clear? Okay, that's clear. Next, we must get the theoretical exercise share price. The current value of the shares of the company is 192 million. The value of the new shares is 45 million. And combined wise, how many shares do you have? 20 million old share plus the 5 million new share. They have the value per right, therefore is equal to 9 point.
So why did you add 45 and 5?
Because what's the current value of the share of the company? The current value of the shares of the company is how much?
192.
192. What's the value of the shares to be issued? 45 million. 45 million. That's why therefore I added 192 plus 45 million.
Okay, yeah, I get it.
Okay, good. Therefore, what's the theoretical exercise share price? 9.48. 9.48. Therefore, theoretical exercise share price. Okay, simple that. Then C, compute the value of rights per existing shares. Okay, we see that we can therefore get the number of value right to be equal to in 2A. Okay, therefore if you define the number of rights to be equal to the new shares, if they've given us, therefore this will be equal to the value of right. Therefore this is right value will be equal to, okay, the theoretical exercise share price minus offer price is equal to 9.48 minus 9, therefore 0.48, the value per right. If we define the number of rights to be equal to the old shares, the existing share, like being as share will be equal to the current market price MPS minus theoretical exercise price, the drop in the share price, which is 10 minus, was it 10? What's the current share price? 9.6. It is 9.6, sorry, not 10. 9.6 minus 9.48, give therefore 0.12 be the value per right, depending on how you define the number of rights to be equal to. Clear? Clear?
So, sir,
Mm.
when you're asked to compute the value of rights as per existing shares, you do two methods: new shares and existing shares.
No, okay, I'm trying just to for our own. Look, this is the answer to the question. This one, the answer to the question. But I've tried to show the both method.
Okay. Yeah.
You get it?
Yeah.
Okay, great.
Just for existing shares. Yeah.
Okay. Therefore, let's look at the number of rights. Okay. The question examiner had asked, which I think I want you to do. Is the question bank. Once you can get it. Is a section 8 type of question, which is, which I think I would want you to first attempt it. It's really easy, by the way, which has been asked by examiner in the past. Once you can get it. Yeah, the examiner was asking you to get the value of a right. Okay, let me just search. I hope I can be able to get it.
So I got one.
You got one?
Yeah.
It's where?
It's page 78.
Page
Question
78.
15.
I guess should be this page. Okay, 78. Mine is page 77. Question 15. That's one. Okay, page 77. Page question 15. Attempt to read in the next 1 minute. You can do that for sure quickly. Page 77, question 15, the one that is on the screen. Brian, what do you have?
I got 2.8, so I'll be doing it.
Sorry, you got what?
I got 2.8, so I'm doing it.
2.8, and it's not among the choices here. Okay, Daisy. Daisy.
I got 1.6.
1.6. Okay. Nafisa, what do you have?
So I'm still doing it.
You're still doing it, Sanya.
So I got 1.6.
1.6. Sakina, what do you have?
1.6.
Okay, the value of right per existing share. Okay, so here we need to get to know what is the theoretical exercise share price first. Okay, it is a 1 for 4. One is share, which you need to pay how much? This one is share, how much you pay for 6. Okay, 6. You need to have 4 share for it to 4 share for it to be to buy this one share. Times the price per the new share, which is per old share, is 8 divided by 5. Therefore, what is the theoretical exercise share price? You done this already, I guess.
7.6.
7.6. Okay. They are together. Therefore, the value of right per existing share, therefore, is given. It will be equal to the current share price, MPS. We divide by the offer price. So you divide by theoretical exercise share price. Current price is equal to 8. Theoretical exercise share price is equal to 7.6. Therefore, 0.4. How do you guess 1.6?
So I did 5 million
5 million.
plus 15 million, which is 2.5 million shares times 6.
No, you can't do that because 5 million, this is the nominal. This is the nominal value of the company share, not the market value. Unless you want to, what you can do is that in case you want to, this converts to 10 million share. 10 million share, we multiply by the current market value, which is 8, plus the value of the new share being offered. Okay, this is a 1 for 4. You be getting therefore 2.5 million share times the value per share, which the value of the new shares being offered, which is 6, divided by the reverse sum of share, which is 12.5 million. You can do that, but you can't use 5 million for sure because 5 million is the nominal, not the market value, not the market cap.
Oh, okay.
Yeah. Okay. Sanya, how do you get 1.6? Sanya? So in class. I think we also okay. So
Sorry?
yes.
I don't understand how you get 7.6.
No, it's 0.4. We got 0.4, not 1.6.
No, 7.6. Like,
You got 1.6.
no. As in, how did you get 7.6?
Or 7.6.
Yeah.
From here, the value of the current share plus the value of the new share divided by the number of shares after equals to 10 million. Currently, this company has the share has a nominal value of 0.5. The easiest way is just to simply use this offer rate. You're being told you're going to get one new share for every 4. So the new share, how much do you pay? You pay $6. What's the value of the old share you had? There were 4. What's the value per those new share? It was 8. Therefore, 4 times 8. Therefore, what's the revised number share be having after? 1 plus 4 gives us 5, gives us 7.6 therefore. Or you can use this method. The value of the old share, we divide by the value of the new shares. Clear, Nafisa?
Yeah.
Okay. Don't forget, as I mentioned, you can also use this method, okay? This method. Simply get the current value of the shares of the company plus the value of the new share to be offered, divide by the number of shares, the revised number of shares, which will be equal to 10 million plus 2.5 million, give us 12.5 million. By the way, in case you use the method, what do you get to be the theoretical extra share price?
7.6.
7.6, yes. And you get the same like what we got here. So whatever method you use, you get the same answer at the end of the day. Brian, it's clear?
Yes, thanks.
Okay. So let's apply. That was one of the questions that I've seen your examine asking you to get the value of a right. Let's run a question which now is asking us to apply the question. Okay, so let's look for a question asking us to apply the concept of right issue shares. This is a good one, this one. This is page 7. In my question bank, it's page 7, page 8. A company called Dirty Company. Page 7, page 8, a company called Dirty Company. Okay, so go through it. We discuss together. Dirty Company, page 7, page 8. Let's attempt to do it together. So being asked here to get the company theoretical expired share price. Okay, and the share price in case to use the P ratio method, and whether the proposed expansion is acceptable to shareholder. Okay, based on their effect on well shareholders. Okay, let's read together. So if you do that, the company will issue, it's a 1-for-4, and the issue price is 20% discount from the current price of 2.5. Therefore, the offer price is equal to 20% or simply 80% of the current price, 2.5, which is how much? 2, exactly 2.
Yeah.
Brian, you're breaking?
Yeah, 2.
Okay, 2, great, okay. Therefore, the theoretical exercise share price, you're going to get 1 new share, which you've paid 2, but you must have 4 share, which the current value is 2.5. Therefore, combined wise, the total number share the total number shall be having is 1 new share plus the 4 old share gives us 5. Therefore, 2 point be the theoretical exercise share price.
2.4.
2.4, get 2.4, therefore to be the theoretical exercise share price. And generally, look, this is it's in theory. Okay, so let me suggest this is in theory. Okay, this is in theory. That generally, okay, if the share price will be at 2.4, the real shareholder remains constant. Okay, the real share remains constant. If the share price after, okay, don't forget this is this is like a forecast we're doing that we are anticipating. Okay, that once this offer has expired and things have settled down, then the share price will be at 2.4. where the wealth of shareholder remain constant. If the shareholder's wealth is going to be, if the share price then, okay, assume the case we were doing, where we issuing today, November, the expiry date is in end of month of February. So if the share price end of February, that is in 2021, will be at 2.4, the wealth of shareholders remain constant. If the share price will be higher than 2.4, there's an increase in the wealth of shareholders. If it will be lower than 2.4, there's a decrease in wealth of shareholder. In short, this is like sort of the benchmark where the shareholders' wealth remains constant. A price higher than 2.4 means more wealth. A price lower than 2.4, decrease in wealth of shareholders. I think that's something to take note of, okay? Because that will be formed the basis of discussing, I think, part C. Calculate the accurate share price following the proposed expansion using the PE ratio. If the company goes ahead with the expansion, you've been told the earning per share, the price and ratio of the company has been constant in this year. So we can get the PE ratio, MPS, we divide by earnings per share. In short, the PE ratio is simply the market appreciation of the company earnings, okay, because you're comparing earnings with the MPS, okay. Therefore, if you have to use the recent year, in this case, I want to use the recent year is which year? 27, okay. The earnings here, that's 2.4. Or is it given to us the PE ratio? Is it given to us? No, it's not given to us. Okay, to put that 4.2, the 2.4, we divide by 15. The PE ratio is how much? No, this is the earnings, sorry. MPS, this is, I'm using the wrong method here. The current price is 2.5. The earnings then was at 2.4, 0.324. To give us how much? 7 point.
So aren't you using 2.4 instead of 2.5?
No, don't forget 2.4 is theoretical. 2.4 is in theory. P ratio is the current market price per share, MPS, divided by earnings per share. No, we're not using 2.4, we're using 2.5, the current market price per share.
Okay.
Well, this is, don't forget, let me actually just put, let me go back to the graphic we had drawn. We see it here. Is this? Yes. So don't forget here, we are now this today. What's the P ratio today? Is equal to the MPS, current market price per share. We divide the current earnings per share. Okay. Then the theoretical share price is what we are expecting, what will be the share price from the 1st of March onward. This is called the theoretical exit share price. In theory, we are anticipating that from 1st of March, after the expiry, theoretical X, right? This is the exit here. This is what we expect the share price then will be equal to 2.4. So today, you can't use 2.4 because 2.4 will be in maybe 3 months' time from now, in the month of March.
Okay,
yeah.
But the question says that calculate the expected share price following the proposed business expansion.
Using the PE ratio. The PE ratio is as per today. I agree, but the PE ratio is per today. Always.
Okay.
Yes, always is per today, the PE ratio. Okay. So you get a PE of how much? PE ratio of how much?
$7.72.
7%, okay. Get 7%, therefore to be the PE ratio. And we assume that it remains constant. The PE ratio, we assume it remains constant even into the future. Okay. Now, if the bill, once the company make the investment, we told that if the company goes ahead and make do the expansion, then this is going to allow the company average growth in earnings per share over the last 4 years to be maintained into the future. Therefore, we need to get a growth. The growth of the earnings of the company, the earnings per share, okay, in 2007, okay, earnings per share in 20303. We want to get a growth per year. Then between 27 to 3 and 27, those are 4 years. Therefore, the power of a quarter, okay, minus 1. Because we want to get what's the annual growth. Because if the company goes ahead and make this expansion, this is going to be able, this will make the company sustain this growth. Okay, therefore, this will be equal to that 2.4 divided by 27.7 over 4 years minus 1. Therefore, what will be the growth in the company earnings?
.4%.
No, don't round off.
3.995.
Okay, 4%. Okay, that's okay. So you can say the 4%, therefore the annual growth in the dividend. So you do that if the company goes ahead and make with this investment, then they will be able to sustain this growth in the future. We imply, therefore, if the company goes ahead with this expansion, then we extract the earnings per share, expected earnings per share, to be equal to 1.04 times the recent, that's 2.4 cents. Therefore, what will be earnings per share if the company goes ahead with this expansion?
33.7.
That's 3.7. 3.7 cents. Okay, which implies, therefore, this is the earning the company expects. Therefore, based on the P/E ratio, if the P is given us MPS divided by earnings per share. Therefore, the MPS we expect, therefore, will be equal to the P/E ratio. We multiply by the earnings per share. The P/E ratio is 7.7% put 2 times earnings per share, which is expected with the 3.7. Therefore, is the MPS expected. Okay.
2.6.
$2.6. Okay. Now you go back to our original comment. We said that if the share price will be at 2.4, the theoretical exit share price, then the wealth share has been constant. Now, what the share price now? 2.6. Is it increasing wealth of shareholders?
Yes.
Yes, it is, definitely. Okay. So how? We need to leave that evaluation. Okay. So here we can make a comment. Okay. There's an increase. The proposal will result to an increase. This is part C now. This is part C now. And try plus part C. Okay. It will result to an increase in the shareholders' wealth. Shareholders' wealth, since the expected market price per share $2.6 is greater than the theoretical extra share price. Maybe just we got a bracket here where shareholders' wealth was meant, where shareholders' wealth was to remain constant. $2.4. Okay. So in case the share price here was 2.4, then it remains constant. If it was 2.3, then that's therefore that's not good. Or there'll be a decrease in the shareholder. The benchmark is 2.4. The benchmark is theoretical extract share price. We can go ahead and do further analysis, okay? Because these are 5 marks. So of course, if you can't get 5 marks by just doing what you have just done there, this is going to give you maybe 2 marks, maybe. Okay, we need to go ahead. Yes.
I just got confused. Where did we look for the 4%?
4% from the earnings, the growth in the earnings of the company.
It's like the growth from 2003 to 2004.
Yes, but yearly growth now, yearly growth. The growth was from 27.7 to the 2.4, but for over 4 years.
Okay.
Therefore, what's the growth per year? Then we do the part over quarter, like you've done here.
Okay. So,
clear?
Yeah, so by that we were just trying to look for the market price share, right?
The end objective was to get this, was to get the MPS, the expected share price here, 2.6. That was the end objective.
Okay.
You don't sound okay. Nafisa, it's clear?
Yeah, it's clear.
Okay, great. So therefore, as I mentioned, this is not going to give you 5 marks. So you need to do further analysis. So you can do, if you remember, we said that the return to the shareholder or shareholders wealth, okay, how do you get it? Shareholders return, okay, return to the shareholder is given as P1 minus P0, okay, plus the dividend, okay, we divide by P0, okay, of course, therefore we express this as a percent, okay. So we need the return, therefore, what is therefore the dividend that we expect, okay, the dividend that we expect, D expected, So based on the payout, if you have to use, let me just use 207, the payout for 207. So here I need to get the formula, the payout. So the payout for 207, the company made earnings equal to, they paid 15 cents out of earnings of that 2.4 cents. Therefore, what was the payout here? What is the payout ratio as per 207?
$46.296.
46.3.
Yeah.
Okay. Therefore, the payout for 207 was 46.3. We will be making the same assumption that in the next year, in 28, the company will pay out the same payout, 0.463. The earnings they will be making, which you've already done, goes to 3.7 then. Yes, we got it here, the 3.7. The company pay, therefore, 0.337. And you get how much to be the dividend that we expect to pay?
$0.156.
0.156, that way. Okay. The company, therefore, we expect that the company will be paying a dividend of 15.6 cents. So you have the P1, you have the P0, be the benchmark. Okay, we have everything we need. Therefore, return to the shareholder after the expansion, the share price will be 2.6. I think you've just done right now. P0 is the benchmark, which was 2.4. The dividend is how much? 15 cents, 0.156. We divide by 2.4. Therefore, come return to the shareholder if the share price will be at 2.6. Don't forget the benchmark is 2.4. Don't forget that. And get how much? The share price?
14.8.
14.8%. Therefore, the return you'll be getting is 14.8%, okay, from your investment. What return did you require? Let me repeat. You as a shareholder, when you invest in this company, there's a return that you are requiring. You say that this is my bare minimum return I want. How much was it? You guys, are you in today? What's happening today? Sanya and Daisy, you're too quiet.
Sorry, sir, please repeat the question.
I'm asking the shareholder, by the time you are investing in a company, there's a return that you require, isn't it?
Yeah.
So what return were you requiring as a shareholder in this company?
Dividend?
No, it's the question, by the way. It's given the question. The company, the return you're receiving, okay, is 14.8%. But before you made the investment, it's a return that you wanted. How much was it? Daisy?
Yes, sir.
Yes.
Let me check the question.
Hey, Daisy, are you in the same class? What's happening today?
I'm a little unwell.
Okay, sorry for that. Sanya? Hey, Brian?
So is it 10%?
Of course, 10%. Yes, 10%. Therefore, you are requiring 10% return. But this project has given you 14%. Is it a good investment for you?
Yes.
Yes. This is a good investment. The proposal, the proposed use of funds is financially acceptable. You make a comment therefore, is financially acceptable since the return received, the extra return, the expected shareholders return 14.8% above is greater than the cost of capital, than the required rate of return of 10%, the cost of equity. That's what you meant to have done in that part C. Question?
So how is cost of equity the same as return?
The cost of equity, it's what we call, to you as an investor, the time you invest in a company, there's a return that you require, isn't it?
Yes.
Assume 10%. To the company, what is it?
Oh, the cost.
It's the cost, yes.
Yeah.
Okay.
Okay. Yeah.
In the question? Okay. Another question then. Great. I guess we can end the class here. And I tried to ask the administration to give us some few hours, but it is not possible. So we'll have to squeeze and work with what we will have. Okay. So let's see how far you can be able to go. So most likely I will not be able to discuss some topic. Okay. Because okay. But anyway, let's see. I'll now try to concentrate on the core areas now that are remaining. Okay. But I propose definitely this question regarding the ratio share. These are a frequent area. So therefore, the next time we meet, we shall attempt to do maybe 1 or 2 questions. Because the examiner normally asks this question for sure.
Okay. Excuse me, sir.
Yes, yes.
Now that the administration is refused, isn't that a little unfair on our side?
I know.
Okay,
Yeah.
are there revision classes then?
No, that's the thing. I don't think we even have a time for revision. I don't think we even have time for revision.
Wouldn't they allow us to have revision classes on days we don't have classes? Is that possible?
There is to have classes.
Like on Saturdays or Fridays?
No. I don't know. It's quite complicated. I tried to talk. It's quite complicated. I tried to talk to them, but it's not possible. So have we missed any class? Because that can be a thing. We try to see whether there's any class that we have missed. So that we can
There's no
justify
class
us
I
having a
think we've
makeup on that.
missed.
Sorry?
With the class we missed, we did a makeup for it.
We need a makeup for it now. I don't know.
So there was one class. I don't know if we did another for that. The first week, the first or second week, we had a power class or something. Yeah.
We missed. There's a class we missed.
Yeah, I think so.
Okay. If you can
the second week on Tuesday, I think.
Wow. Let me know so that will be easier for me even to organize on my own. If that we have missed, I can just tell them, hey, there's a class that we have missed in the past, and I'll be trying to make it up for it. Okay.
Yeah, there is, because I think because there are no recordings for that in on YouTube, and also we have cats lesson, cats, a
the
session
time
for
for the
cats.
cut. Yes. That's what we
Yeah,
shall
so
do
we
then.
can use that.
Yeah, let's do that. Yes, I think that could be better. We tell them that those were days for the cuts. Instead of doing the cut, we do have the normal class. How many days are they? We have the cut. I don't know. We
On
can
Friday only.
on Friday. Yes, that's what we shall do then. That's what we shall do. That's I think what we can do. Okay, yeah, I think that's what we can do. We tell them that that's for the cut time for the cut. Yes, that's when we can do that. Tomorrow at 10,
So,
how are you guys? And I agree that what we can do, we can try to squeeze, maybe we can just tell them that those are the time we're doing the cut. We can try to squeeze 2 classes, I guess, first try it as we try to finish up on this. So I agree on the on the what do you call it, on the WhatsApp group on the time that I think we can tell them that we those 2 days work for the cut. Agree on the group when you can have it. Okay, tomorrow I'm free from 10. I'm free, so in case you can be able to organize one tomorrow, then that would be good for me. And even on Friday, so either of those 2 days, you can let me know. We can organize makeup. We tell them that this was time for the cuts but instead we have the class. I think that would be better. That at least can give us some few more hours. Here.
Yeah.
Okay, great. Fair enough. Then yes.
I wanted to ask, is there a lot, like, will we be able to finish all the topics before, like, even after the covering classes?
Yeah, I guess we can. I think we can be able to finish up. What might be the issue? Maybe time for revision. That might be the issue now. But I guess maybe I think we can. If we have like, because this will be 2 hours. 2 hours will be 10. The next week, that's 2 hours. This will be 2. If we do the makeup for two classes are 4 hours, plus next week 8 hours. That's 12 hours. I think we can go to finish up. Yeah, I guess we can go to finish up. Yes, we can.
Okay.
Yeah, I guess we can. So agree as soon as possible. Okay, let me know when you can have this makeup so that we organize them as soon as possible.
Okay, and so